They called him the man who broke the bank. One trader, one desk, one decision, and a loss so massive it sent shockwaves through Europe's financial system. In 2008, while the world's markets trembled under the weight of a global financial crisis, one quiet man inside Société Générale, France's second-largest bank, secretly risked billions. His name was Jérôme Kerviel, and his actions would become one of the most infamous financial scandals in modern history. This is not just a story about numbers. It's about trust, greed, and the invisible line between brilliance and destruction. Because at first glance, Jérôme Kerviel didn't look like a villain. He wasn't a Wall Street hotshot or a billionaire hedge fund owner. He was, by all accounts, an ordinary man, born in a small French town, polite, soft-spoken, and disciplined. But beneath that calm exterior, a storm was brewing. A storm that would eventually cost his bank $6.9 billion and make him one of the most hated men in Europe. So how does a man like that, working quietly behind a computer, bring one of the world's biggest banks to its knees? To answer that, we need to go back to where it all began. Jérôme Kerviel grew up in Pont-l'Abbé, a small, peaceful town in Brittany, France. He wasn't rich, he wasn't connected. His parents were ordinary working-class people. He studied hard, earned a master's degree in finance, and joined Société Générale in 2000, not as a trader, but in the back office, the part of the bank that handles risk management and compliance. That's right. The man who would one day cause the biggest trading loss in history started his career checking other people's trades for mistakes. It was there that Kerviel learned something powerful: how the system worked, and more importantly, how to hide things within it. He understood how risk reports were filed, how trades were validated, and where the blind spots were. To most people, this was just boring procedural work. But to Kerviel, it was knowledge. And knowledge, in the financial world, is power. A few years later, he moved to the front office, the holy grail of finance, where trades are made, fortunes are won and lost, and the adrenaline never stops. He wasn't a superstar. He wasn't loud. He didn't drive a Ferrari or wear a Rolex. But he was clever, analytical, and above all, ambitious. He wanted to prove himself. And in a world dominated by Ivy League graduates and Parisian elites, Jérôme Kerviel, the small-town outsider, felt he had something to prove. At first, he played by the rules. He made small trades, stayed within his limits, and quietly learned the rhythms of the market. But like every trader, he began to crave more. More risk, more returns, more respect. It started small. A trade here, a hidden position there. He discovered that if he hedged one position with another, he could create what looked like a neutral trade, a position that, on paper, didn't break any rules. But behind the scenes, he was building enormous exposures, positions worth tens of billions of euros, hidden behind fake hedges and false entries. Kerviel had found the system's blind spot. He knew exactly how the compliance teams checked for risk, because he used to be one of them. He exploited that knowledge ruthlessly, and as long as his trades made money, nobody asked questions. By 2007, he was earning profits that dwarfed his peers. The bank praised him, his supervisors congratulated him, and his confidence grew. But here's the thing about success in trading. It's addictive. And when you've tasted big wins, small ones no longer satisfy. So Kerviel began to gamble bigger. Much bigger. At one point, his hidden positions were worth 50 billion euros, more than the entire value of the bank itself. To put that in perspective, it's like a single employee secretly betting the entire company's worth on one coin toss. But markets have a way of humbling even the boldest. And in early 2008, when global markets turned volatile, Kerviel's positions began to unravel. The fake hedges couldn't hold. Losses started piling up. And suddenly, the cracks in the illusion became too large to hide. On January 18, 2008, Société Générale's risk control department uncovered discrepancies in his trading books. At first, they thought it was a mistake. But as they dug deeper, they realized the scale of what had happened. Billions of euros in hidden trades, thousands of falsified documents, and a trail that led straight to one man. The discovery sent shockwaves through the entire bank. Executives panicked. Over one frantic weekend, Société Générale tried to unwind all his positions before the public found out. But as they sold off the trades, markets reacted violently. Prices collapsed further, and the total loss ballooned to $6.9 billion. When the news broke, France was stunned. A single trader had just caused the biggest trading loss in world history. Kerviel was arrested, interrogated, and paraded across the media as the man who brought a bank to its knees. But behind the headlines, a bigger question emerged. Was Kerviel truly a rogue trader? Or was he simply the fall guy for a system that rewarded risk-taking until it went wrong? Because here's the uncomfortable truth. Before the scandal, Société Générale had been celebrating Kerviel's profits. Nobody cared how he made them, as long as the numbers looked good. Risk managers ignored red flags, supervisors looked the other way, and upper management collected their bonuses. Only when the losses appeared did the same people act shocked and point fingers at the one man who couldn't defend himself. Kerviel claimed that his bosses knew about the trades. He said the culture of the bank encouraged risk, and that everyone turned a blind eye as long as the money kept flowing in. The bank, of course, denied everything, and in 2010, Jérôme Kerviel was sentenced to 5 years in prison, with 2 years suspended, and ordered to repay the full amount, all $6.9 billion. It was a sentence that shocked many. Not just because of the scale, but because it felt impossible. How could one man repay billions he never had? He appealed, fought, and continued to insist that he was not a criminal, but a scapegoat. Over the years, public opinion began to shift. People started to see him less as a villain and more as a symbol, a product of a broken system where massive risks were taken daily, hidden under layers of complexity, and blamed on individuals when things fell apart. Even the French courts later reduced his financial penalty, acknowledging that the bank bore significant responsibility. But by then, the damage was done. His career was over, his name forever associated with financial disaster. Yet the lessons from his story go far beyond one man's downfall. What happened at Société Générale exposed the fragility of modern banking, how complex systems can fail when human ambition overrides control, and how the very people meant to guard the system often benefit from its risks. Think about it. A mid-level trader, without insider connections or special access, was able to bypass every layer of security inside a billion-dollar institution. That tells us something terrifying, that the real danger isn't rogue traders. It's blind trust in systems that aren't as foolproof as we think. Kerviel's story also reminds us of the psychological trap that traders face. When you start winning, you feel invincible. When you start losing, you believe you can win it back. And before you know it, your entire world depends on the next tick of the market. It's not greed that kills most traders. It's hope. Hope that one more trade will fix everything. After serving his sentence, Jérôme Kerviel emerged a changed man. He spoke publicly about ethics, transparency, and the toxic culture of financial institutions. He walked across France on foot to raise awareness about inequality and the moral decay of modern finance. He became, in a strange way, a folk hero, not because of what he did, but because of what he represented, the small man crushed by a giant machine. But whether you see him as a hero or a villain, one thing is undeniable. His story changed the financial world. After the scandal, banks across Europe tightened their risk controls. Regulations were strengthened. And the term rogue trader became a warning label for unchecked ambition. Even now, years later, traders study his case as a lesson in both genius and failure. Because what Jérôme Kerviel did required extraordinary skill. He understood systems better than anyone, but he used that knowledge to deceive, not to protect. And that's the ultimate irony. The man trained to prevent risk became the risk itself. As we look back on the $6.9 billion mistake that shook Europe, one question still lingers. Was Jérôme Kerviel a criminal mastermind or a symptom of a much larger disease in the financial world? Maybe both. Because for every rule written after him, the same game continues, just played by bigger players with better technology. The faces change, the systems evolve, but the temptation remains the same. And perhaps that's the real message behind his story? In finance, it's never the numbers that destroy you. It's the illusion that you're in control. So the next time you hear about a trader making millions overnight, remember Jérôme Kerviel. Remember that behind every headline profit, there's a risk someone's not telling you about. And remember that in the end, every market, every algorithm, and every institution is still run by people, imperfect, ambitious, and human. Because all it takes is one mistake, one man, and one moment to change history forever. This was the story of Jérôme Kerviel, the trader who made the $6.9 billion mistake that shook Europe. If you found this story eye-opening, subscribe where we uncover the hidden truths behind the world's greatest financial stories, from the geniuses who built empires to the traders who brought them crashing down. Stay disciplined, stay curious. And remember, in the world of trading, even a small misstep can echo louder than you ever imagined.